Welcome to This Week in Coworking, where industry leaders get succinct, actionable insights.
Welcome back, everybody. I'm Hector Kolonas. I'm once again joined on the This Week in Coworking podcast by my co-host, Mike LaRosa. And today we're joined by David Auerbach, who is the go-to source for all things REITs. But before we dive into what that is and what it means to you and your co-working business, David, how's things looking this week?
Well, post-holidays, Jobs Friday, so a lot of headlines that are out there. Bitcoin crossing $100,000 this week. You know, it's why we're on Wall Street. Every single day, it's a new headline. It's something new to focus on, but it's great to be here with you both, Hector and Mike, and thank you for having me.
Pleasure. Thank you for joining us. I know it's a very busy week, as you said, and you did say you're on Wall Street. Can you tell people a little bit more about what you do all day? Does David do?
Good. Cool. What don't I do? I've been in the real estate investment trust REIT industry for 25 years in a variety of capacities: sales, trading, marketing, public relations, or investor relations, portfolio manager. These days, I'm the chief investment officer of a firm called Hoya Capital. We are a REIT and real estate research platform, predominantly housed on a website called Seeking Alpha. We run two REIT and real estate exchange traded funds, ETF products. The Hoya High Dividend Yield ETF, ticker RIET, the Hoya Housing 100 ETF, ticker HOMZ. Combined, the two funds have around $140 million under management. I'm also the publisher of the daily REITBeat newsletter. It's an aggregation newsletter that covers 200 publicly traded REITs, focusing on headlines, ratings changes, performance metrics, and all the relevant news articles published coast to coast highlighting the REIT industry. I'm a REIT industry consultant, but basically at the end of the day, and why I'm here, is I represent the world of real estate investment trusts. I try to help advisors, clients, and everybody in between figure out what are the best REIT stocks for them, what are the best REIT stories, but frankly, at the end of the day, why real estate investment trust should be inside every client's portfolio, focusing on the long-term leases that are in place with these clients and customers, and trying to ignore the day-to-day headlines that we see regarding the 10-year treasury or where the federal funds interest rate is at and how it does relate to the world of real estate investment trusts.
I love that. And you definitely did introduce what REITs are. Thank you for doing that. If I was to ask you to explain exactly how a REIT works or a real estate investment trust works to a 5-year-old or maybe a 6-year-old, how would you explain it?
Sure. So first of all, a REIT is just a tax structure. That's all it is. In order for a company to qualify as a REIT, it has to pass basically a bunch of rules. Minimum shareholder count, the income passed through to the shareholder, et cetera. But really, a REIT is just a tax pass-through vehicle to investors. So to answer your question, just speaking to a 5 or a 6-year-old, you go to Dunkin' Donuts and you buy a donut. Dunkin' Donuts or that particular location earns revenue off of that transaction. After they've paid their bills, the profit is basically passed through to shareholders in the form of dividends. There's about 20 different asset classes when it comes to the world of real estate investment trusts. And we interact with these properties, frankly, 24 hours a day, 7 days a week, 365 days a year. The perfect example is right now, we are utilizing a REIT to handle this conversation that we're having. A data center is basically hosting this conversation through the cloud. Another good example is if you order an Amazon package off of your cell phone, you use 3 different REIT sectors: a cell tower to send the order, a data center to process the order, and an industrial warehouse to deliver that order to your doorstep. But there's also office buildings, apartment properties, self-storage units, shopping centers, malls. The list goes on and on. So we're interacting with these properties every single day. You may think that Kroger or Albertsons owns that shopping center when in reality, they don't. You may think Starbucks owns that store where you go and get your cup of coffee every single day. They don't. You may think the Postal Service owns the post office, and they don't. So it's important for anybody to really, what I call, lift up the hood of the car and examine what's going on inside the engine that pushes that car down the road. And we can go a lot further into it, but that's basically from a very high level what a REIT is.
Appreciate that. That's actually a really interesting way to think about it, and I love the excellent analogies. What would be so it's basically an investment vehicle to buy real estate revenue that pushes off dividend cash flow, right? And that goes back to the people who hold the shares in that.
Well, I'm not trying to cut you off, but I'll take it take it a step back.
Please.
You can go out and buy that office property down the street for, frankly, tens of millions of dollars. Or you can go out and buy a share of, let's say, SL Green, the ticker is SLG, at, I want to make sure I'm giving the right information here, so bear with me one second. You can go out and buy a share of SL Green at this moment for a whopping just call it $75. And that $75 investment gives you a very, 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 very tiny slice of ownership of One Vanderbilt in New York City. Or you can buy a share of Boston Properties, or now known as BXP, and own a fractional share of the GM building. Basically, by buying these publicly traded companies, you're getting exposure to some of the best assets in the best markets in the best locations. And that's why I think it's so important to understand the real picture of what's going on here, because what's happening in the world of New York office is different than what's happening in the world of, let's say, Los Angeles office. The New York rental market is different than the Dallas rental market. But by buying some of these publicly traded companies, you're basically owning properties coast to coast and collecting an income stream from office users, apartment residents, shopping center tenants, the list goes on and on. So again, it's a way to own fractional ownership in some of these most desired markets across the country. And one point I want to emphasize, the REITs themselves, the publicly traded REITs and the private guys, et cetera, they own real estate. The number one rule of real estate, as we know, is location, location, location. And these companies, frankly, own the best properties in the best markets at the best intersections in the most desirable locations. And when you think to yourself, boy, I wish I could own that property that's located at what I call a Main and Main, the most well-known intersection in town, chances are REITs are going to blanket those properties at that four-corner intersection. As an example from where I sit, I've got a REIT-owned shopping center about a quarter mile the road down this way. I've got 2-3 publicly traded shopping centers that are about a half mile down this way. An apartment REIT has a property over here. And so you can't go from city to city without, frankly, being hit in the face by these REIT-owned properties every single day.
That is actually interesting. But what I wanted to highlight there is, are REITs normally focused on a specific class or type of real estate, or diversified? Do they have splits? And if we do see splits, who are the most famous or most popular office REITs?
Okay, so that's kind of a layered question that you asked me there. So let's kind of break it up a little bit. There are pure play REITs, guys that, let's say, just own apartments or just own industrial warehouse properties. But then there's also what we call diversified REITs that do have exposure to office and shopping centers, or office and residential, or some combination thereof. Wall Street 2024 going into 2025, from a very high level, and again, I don't want to generalize, but diversified REITs aren't as in favor as pure play REITs. And the reason being, frankly, the more complicated the story, the harder it is to understand. Meaning, if I own office and industrial, we'll just use two extreme examples. Industrial's been on fire office has been not on fire, but because I have exposure to office, my stock is trading at a discount because of the fact that we have exposure to a sector that isn't necessarily as in demand as cell towers or data centers or industrial warehouses as a pure play. Number two, there are a couple of office guys that are diversified that have exposure to other asset classes. But from where we sit, I kind of call it the big five, the big six, the big players that are out there. They're pretty much pure play office. If you look at, again, like a Highwoods Properties or a Cousins Properties here in the Sun Belt, they're basically only office. Now, you are starting to see companies like Empire State Realty Trust, who own the Empire State Building, the most famous office building in the country, that are kind of tiptoeing into resi, where they are bringing in, let's say, a residential component inside some of their office properties, or you're seeing like a hotel component coming into office properties. There was a story on CNBC yesterday. It's been around for a couple of years now, but looking at malls converting to residential, or mall properties adding residential concepts to it. A good example of this is a company called Simon, the largest mall REIT in the country, ticker SPG. We're at a couple of the properties, they've added a resi component. A big shopping center REIT, Kimco, has been looking at doing this and is doing this at a couple of their properties. And I think it's a very important subject to tackle because, the biggest issue really from a 10,000 foot perspective is lack of affordable housing. There isn't enough housing supply that's out there for the amount of demand that people want to go out and buy homes. And so what do we do to satisfy that demand? Is it we see an explosion of manufactured housing? That's possible. Is it we see an explosion of apartments and single family rentals? Well, we're seeing that, especially on the single family rental side. But also it's repurposing some of these older, outdated office properties that are basically sitting at 0% occupancy or very low occupancy and figuring out what to do for the next future generations of that. The problem, and I know that you guys probably know this better than I do, the problem is frankly called the conversion cost. When you try to convert an office building into, let's say, a residential tower, you have to rewire, re-wall, knock down, walls and barriers and rebuild, cooling system issues, windows, elevator banks. You could be looking at, frankly, a very, very, very significant capital contribution to make that conversion. I'm not saying it's impossible because we're seeing stories every single day about it, but we haven't figured out how to make it efficient, affordable, whatever the word is that you want to use. And until somebody comes up with that magic idea that makes this whole conversion more affordable, it's going to kind of have you're doing office to resi conversion. Good luck. That must be costing you a fortune.
So converting from pure office to residential, yes, we know that's ludicrous expense, but we are seeing, I'm trying to bring this back to our co-working audience of operators and landlords and such. We are seeing some conversions in a kind of a middle ground where they go from an office to a mixed use property. So it's got traditional office, it's got flex or co-working, it's got some sort of retail, and it's maybe got a small bit of a multifamily type thing.
And you can thank COVID for that, by the way, because all these office landlords are trying to figure out, and if you want to call it perks, amenities, what pieces can the office landlord put into the puzzle so that the tenant's like, oh my gosh, I can't believe my office building put in a Shake Shack. Like, holy cow, I've got to go back to the office because I've got a Shake Shack in my building now. Or a gym or a golf simulator or co-working, or I don't know if you're familiar with a company called Pillar. They do the little office booths. I happen to be good friends with the guys at Pillar. I grew up with them. So again, office landlords are listening to their tenants and their consumers, trying to figure out, like I said, pieces to put in there so that people do come back to the office. But let's take a step back, because I know we're going to get into the co-working stuff. And people talk about office. Oh my God, office is dead. Office is dead. Nobody's going back to the office. That's baloney, number one. Number two, why would I buy the office landlord when nobody's going back to the office? You know? And what people, again, remember I said about lifting up the hood of the car and examining under the surface. The average investor might see the headlines about New York City is dead. It's a 3-day a week in the office, whatever the story that's out there. But what they aren't seeing is that the office landlords are reporting new leases higher than old lease rates that were being signed, improving occupancy. Some of these guys have, frankly, 80, 90, 95% occupancy in some of their buildings, like look at One Vanderbilt, as we briefly discussed before. So you're an office landlord with the most, popular office building in the city at 95% occupancy. But there's a difference between the lease rate and the physical occupancy. How many people are actually in that building, right now on a Friday doing work?
Yep.
The landlord doesn't care how many people are inside the office every single day. All the landlord wants to do is lease the space, get it off the book, right? It's up to the tenant to make sure their employees are coming back to the office. The landlord could care less as far as who is in and out the door every single day. It's up to the tenant to say, hey, Hector, sorry, you're not working 3 days a week at the office. Starting on January 1, you're back in 5 days a week, no questions asked. So I kind of want to get to the end listener to understand this here, that the office REITs themselves are firing at all capacities because they're signing leases left and right. They have no control over the underlying tenant bringing the employees back to the office.
What about those landlords who are now finding themselves increasingly signing on like either management agreements or Rev Plus rent lease agreements, where they're actually seeing an upside to the utilization of the offices? They actually make more money if the office is more utilized. Are you seeing any of that across, is it making any waves across the office REIT sector, or is it still kind of under the radar? Are you seeing any of that?
Not necessarily from where I sit. I'm sure some of the other analysts that cover these names a lot deeper than I do, may have some thoughts there. But I'll give you a good example. Last week, Vornado in New York, I think it was 330 West 34th Street, converted a WeWork lease to an Amazon lease. Amazon basically took over a sublease from WeWork. And why I mention this is that, again, off the top of my head, I don't know what, call it percentage exposure, the office landlords have to the co-working firms that are out there, the Common Desk, the WeWork, all the players better, Industrious, et cetera. The players better than I do. But remember, with the co-working space, it kind of plays back into what I said before. Vornado, again, go back a previous cycle. Vornado doesn't care how many people are working in that WeWork space. What Vornado cares about is WeWork paying the rent. And it's up to WeWork to say to their subscribers, hey, come use our location here at 330 West 34th Street, which is no more, but you catch my drift. So I think it's a good tenant opportunity, but I think after what's happened, again, you guys know this better than I do. I think what's happened after the previous WeWork cycle, especially with them turning back a bunch of these leases back to the landlord, my gut tells me that some of these office landlords might be a little bit more hesitant to wheel and deal in size with co-working tenants versus converting a portion of an underutilized space in a property that's undesirable, putting in some of these private work booths like the pillar thing, as I mentioned before, or something else, where the landlord themselves can offer a co-working type environment directly to the customer. But, and I know we've talked about this before, and I'll go ahead and say it here, I don't see our office landlords actively going out and marketing to the one-man shop, the two-man shop of, hey, come work at this property. It'll cost you $1,000 a month. We've got a conference room for you, basically building out their own co-working spaces. I'm not saying it's not going to come at some point, but I think that if given the choice of sitting on 10,000 square feet in the building and parceling it out to 100 different tenants at, 100 square feet each or whatever the number is going to be, versus converting that WeWork lease to an Amazon for 300 something thousand square feet in one push, frankly, as I sit from where I sit on my chair, I always like to say singles and doubles add up. Of course, we'd love to hit the home runs and grand slams. And these type of leases that we're talking about with the landlord to the direct end user in a co-working space is about as singles as it gets, versus let's sign the 250,000 square foot deal for JP Morgan at 230 Park, and hit that grand slam. So I'm not saying it's not out the window, again, because these guys are trying to figure out unique ways to build occupancy. But again, at the price point, it has to be very reasonable for that 1-2-man shop to frankly justify spending $12,000 to $20,000 to go to the city. Now, New York's an extreme example, right? Again, because who's going to go in from New Jersey to New York to go work at a WeWork when I can just go down the street to Summit, Princeton, New Jersey, wherever, and go directly to the office or to a closer location. But in a place like Dallas, where everything is so spread out, and if I know that there's potentially an office building a mile or so away, 2 miles away, again, because we have to get in our car and drive everywhere here potentially, you might be more inclined to do that. Here's the other thing. There's so much office product that's out there that, you can adapt. And so is it okay if I go down the street here to the Class C property and pay the same rate or a little bit more to have my own office versus going to the Class A property and working at the WeWork type co-working situation a mile that way, right? So it's that cost return analysis type situation.
I'm so glad that you've brought these insights, David. The majority of our audience are independent owner operators or regional operators. And I know that a lot of them have been getting contacted lately by landlords or, portfolio owners that see a successful regional brand, right? And they want to implement it in there to try to connect kind of the disconnect. Because I think a lot of times these operators, they know how to run a great business on a smaller scale, but they kind of don't know how to talk the REIT lingo, right? You mentioned that some of these owners, which I've witnessed, are trying to transform some of this office space into more service or on demand or amenitized. What are some things that an operator might benefit from knowing or understanding when they get approached by an owner? Because I see a lot of mirrors to the hotel industry specifically, right? You've got individuals or REITs that own these buildings. You've got brands like a Marriott or a Hilton or a Hyatt. They don't own the building, right? And most of the times they don't even manage it, right? It's outsourced to a third party. So I guess if an operator is being approached, what's something that you might be able to share with them that they would know or be able to better answer a response for a partnership?
Wow, that's a great question. I think thinking from the landlord's perspective, it's almost like track record, okay? Like, how do we know you're going to be around next year? We're signing a 5-year lease for this property. How do I know you're going to even be here a year from now, 3 years from now, let alone 5 years from now? If you think back using WeWork, and again, I'm not trying to pile on WeWork, but if you think back to that example, several years ago, everybody thought the world was going to, the office world was going to end because of WeWork. And, it's going to completely revitalize. It definitely had a major impact, both to the good and to the not so good, right? So, I think looking at you think about from the office landlord, what's your track record as a co-working firm? What is your, let's say, rental rate and growth outlook? How many existing customers do you have? Are you a local, you mentioned the local sharpshooter, and I want to give you credit on that because I think that's very important. WeWork was not a local sharpshooter, right? Because they're nationwide. But if there's a guy that just focuses on co-working here in Dallas or in Texas, and they're able to connect with that local audience at the local desirable properties at an affordable rate, there's going to be buying. So kind of thinking again, what is your, let's call it internal occupancy for your local firm? So let's have Auerbach Coworking. I've got 500 customers. I grew my customer base by 25% year over year. My rental rates are growing by 15% year over year. My expenses have actually not really gone up that much because of whatever. My profits are growing. Why do you think I'm not going to be here 5 years from now when we've seen this exponential growth over the past couple of years? Remember, past performance is not indicative of future results. What happened last year may not happen next year. All we need is a curveball like a COVID for everything to get blown up all over again, right? But I think from the landlord's perspective, it's, can you cover the nut? Can you cover the bills? Are you going to be able to pay the rent increase when the rent increase goes in next year? Because remember, I'm discounting you to get in the door right now. I'm going to build out your space. We're going to put in the kegerator for you, the cold brew on tap, whatever it is. We, the landlord, we're fitting that cost. But guess what? At the end of the day, really, you're going to be the one paying for that cost, which means, guess what? You, Mr. Renter to Auerbach Coworking, I'm passing that cost through to you. You're paying that cost. So again, that's why I think it's important to figure out, I use this expression. Have you ever heard the expression a looky-loo? You know what a looky-loo is?
Yeah.
I just want to check it out, see what you guys have. Or, dude, I'm ready to sign on the bottom line. I'm ready to sign the 5-year contract with the 10% rent escalator. And here's the proof in the pudding. Here's what I've done. Here's where we're going. Here's where we're at with you guys. Here's where you want us to be. We can do this together. You help me by putting in the amenities that we're looking for. I'm going to help you and draw people to your property. Because remember, again, at the end of the day, that landlord is going to benefit, frankly, in multiple ways by having that tenant. And here's where I'm coming with this. I don't want to say the word every, but most, if not all, office buildings have a convenience store in it, right? Some little type of store where they sell Cokes and chips and candy and whatever. That store is going to get the incremental revenue boost because of the fact of these people coming into the co-working space every day. Or the cafeteria or the restaurant, the Shake Shack in the lobby, etc. If you build it, they will come. If you put the right amenities in place, they will come back to the office. But here's, again, something to think about. I don't want to go drive in traffic for 30, 45 minutes just to go to my WeWork or my local co-working space. I don't want to sit in traffic, again, especially when I work market hours, where you're in rush hour going in, you're in rush hour. And again, I work from home in a home type situation, so it's a little bit different for me. But again, what amenities is that landlord going to put in place to encourage the people to come back to the office, sit and deal with traffic and rush hour and all that nonsense? So is it childcare? Is it great restaurants like we talked about? Is it a golf simulator? Is it the kegerator? Whatever it is, if you build it, they will come. So I just think it's important for the person that's listening to this right now thinks about, is my audience base growing? Is my user base growing? Are my needs changing? Are my clients asking for new amenities that we aren't providing? Are they asking for something that's outside the box that, makes me take a step back and realize, holy cow, if I actually implement this, I can bring in an extra few hundred people because everybody wants this type of thing, whatever it is. But it's a very unique story. Again, one final point here. I hate to keep beating this. Co-working doesn't work in every city, right? There's no guarantee that it's going to be a popular thing in Little Rock, Arkansas, or in Milwaukee, Wisconsin, or, it may be popular in places like New York, Dallas, Chicago, the big metro markets, but it doesn't necessarily mean it's going to work in every single metro.
So just to summarize, David, on your last answer, for operators looking to make better deals with landlords, show your P&L, show your numbers, know your stuff. Um, yes, there's regions where co-working looks different. I would disagree with you that co-working doesn't work everywhere. We're definitely seeing a spurt of tens of thousands of rural co-working spaces, and they're doing fantastic revenues on a tiny scale, but put them all together, it's quite a big number. But I'll put a pin in that. But I do want to ask one final question. That's more around, there are a very growing portion of our listeners who are owner operators. They own the buildings and they run the co-working spaces. Shout outs to the folks at Expansive and in your neck of the woods, the teams at, what were they called? They are called, Tim Slaughter is at, where's Tim Slaughter? Like,
And sure, no.
I'm going to remember this 1 second. Sorry. So my question is, owner operators who happen to own their buildings and run co-working spaces, they increasingly raise funds per building. Should they be looking at like working more with REITs, or maybe even one day forming a REIT instead of raising money per building? Is that something that, what advice could you give to the people who own the buildings through which they run co-working spaces?
Well, first things first is I would say absolutely they should talk to the REITs. Number one being there's no cost in the conversation. You're not out any financial terms whatsoever by just asking the question to the potential office or strip center REIT landlord. So yes, definitely talk to them. As far as starting up a REIT, you got to own a lot of square footage to be able to roll that up and launch a REIT. Now, again, thinking about WeWork, they brought in a REIT person to run the company for, several years because of how that square footage kind of looked like. For the owner operator, remember, they're wearing multiple hats. Not only are they running co-working spaces, but they're also, managing all these other spaces inside the property too, right? So if you're able to pass off some of those responsibilities to a landlord, somebody else, like, again, I'm not calling the owner operator a non-professional, but a professional office landlord, who own millions and millions of square feet of space, that have relationships in place of, suppliers and vendors and everything to make it more efficient. Absolutely engage these landlords and have the conversation. But also think about it from the same perspective of, if that landlord rents that space to that co-working tenant, then that means they can't rent that space out to potentially another tenant, right? And so what happens if you get, I don't know who an office tenant is. Everybody wants to get in the door, but if that desirable office tenant comes knocking, looking for a space, that's an opportunity cost to that potential landlord. And that's why I think the numbers are key here. Not necessarily showing the P&L, as you had mentioned before, but showing user growth. We can't fill out these desks fast enough because as soon as we put one in, it's taken up. Or because we're coast to coast and we give our tenants the opportunity to work in any building that we're operating in, and a guy's in San Francisco today, again, what tools are you going to put in place to bring them in? So where I'm going with this, there are office landlords that have nationwide exposure. Obviously, a lot of the office players are called more regionalized, or they're suburban type players. So if you're kind of able to work out some type of deal, again, with a regionalized guy or a nationwide player, like Blackstone EQ Office is an example. They've got properties, I think, coast to coast. Hey, Blackstone, we'd love to put in 10 locations at, space that you're not using or that you're trying to fill at some of these markets, because then that co-working user or firm may be able to get a better rate because of the fact that maybe these guys are looking to, fill up that space. It's one thing to take down one property, but if I can take down 10 properties in 10 states and you're trying to fill these 10 properties, the landlord's going to work with the tenant to try to fill that out. So that's why I keep emphasizing there is no cost in a conversation. The only thing they could tell them is the worst thing that you're going to hear is, thanks, we're not interested.
Fantastic insights, David. Thank you very much for joining us today. I'm pretty sure with all the craziness that's lining up for 2025, we're going to have another conversation about what has changed between now and then. But we definitely appreciate you coming on, taking time out of your Friday to sit and chat with us today. Where can people find out more about you, David? Where should people go to right now if they're interested in anything REITs?
First of all, before I get into that, I have a feeling when we talk in 25 and we do this again, both you can be like, we told you, I told you what's happening. We were right. So what do you know? We saw this coming. So I won't be surprised when that. You can find me on LinkedIn. You can find me on Twitter. I'm the Daily REITBeat. My newsletter website's thedailyreitbeat.com. I'm not very hard to find.
Fantastic. Well, thank you very much, David, from all of us. Have a fantastic holiday period, and we'll see you again in 2025.
Thanks, guys. I appreciate it. Have a great weekend.